Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the man, myth, the legend, Mr. Jonathan Twomley. How you doing, sir?
I'm doing great, Michael. How are you today?
I'm doing very, very well. So I just read an article about multifamily, specifically larger apartments, from I think it was Realty Mogul. I'll put the link below in the description once this is loaded. Talking about rents getting soft. Q3, as you know, is usually a strong quarter because it's the summer quarters. People move in, move out, get schools, all of that. Rents were down 0.4%. Usually they're up. Vacancies were up a full percentage point, although historically still pretty good at only 4.1%. But there's a lot of things going on in the multifamily space. You and I have talked about higher rates, higher cap rates, inflation and costs, labor, taxes, insurance. And now we're kind of losing the revenue side. So lots of stuff going on in the apartment space. And I think there's some pain ahead just as we kind of level set across the board. But you're in that game, so I thought I would ask you.
Yeah, I mean, listen, so what I'm seeing is that, I mean, multifamily has had an extraordinary run over the last couple of years. So it's had a really good run for 10 or 12 years now, but the last 2 years were really just pretty nuts. And I think everybody kind of recognizes that pricing went to a level that nobody expected because in 2019, nobody thought it could possibly go any higher than it was. And then it did, right? And rents, nobody thought rents could accelerate more than they were, already accelerating, and then they did, right? So I think what you're seeing now is a lot of, frankly, just reversion to the mean, right? I mean,
I
we're
agree.
just going back to, I mean, we're not even going back to normal yet, right? We're just going back to where it was in 2019, which everybody thought was extraordinary. But the problem is that when you go from like super off the charts incredible to just like really good, it feels painful, right? So and that's what the industry is going through right now. It is going through a bit of a painful readjustment because a lot of things are hitting at the same time, right? So obviously, like you mentioned, inflation has driven up the cost of running apartments. People are pushing back on the extraordinary rent increases because frankly, they just don't have I think, frankly, I think independent of inflation, I think you would be seeing this anyway, because the rent increases, I mean, you were talking last couple of years, people, on lease renewal, getting like $500, increases in their rents, right? They're getting like 25-30% increases in the rents, and they were paying it, right? But they could afford that maybe once. You can't do that every year, right?
Agreed.
And expect people to stay. So I think the time of the extraordinary lease rent increases was going to end anyway, but inflation now taking a bite out of people's paychecks, not just in terms of rent, but in terms of everything else, means that they really are people just, you're not going to get those kinds of rent increases again. So I think what we're seeing is a little bit of a more of like a return to normality in the apartments space, right?
Yeah, but you and I have been doing this a long time, and you and I, well, first and foremost, I sold a couple of apartment buildings in 19 because you're right, I didn't think they'd go any higher, and turns out I lost $500,000 because they did. It happens. But now as I sit here kind of in late 22, I'm looking at the deals that were done in 2020, 2021. You and I have talked about the horrible debt structure, short-term IO, often called bridge debt, value add opportunities. You and I have talked about assets retrading 2 or 3 times
Mhm.
in these windows. And you and I both know there were some horribly aggressive assumptions on the positive side. Now
Yeah.
that we've got reversion to the mean, and I would argue a trend, there's going to be a lot of pain. And there's some deals that could be that will be hurt. The question is how many, I suspect.
Yeah. So I mean, so let's just take a step back and like make an analogy to the great financial crisis, right?
Sure.
The properties that got hit, it wasn't that across the board people lost their homes because their mortgage rates reset, or they were underwater. It was really the people who bought at the absolute top right, were the ones who got foreclosed on. Essentially, like in retrospect, because at the time everybody thought that they were doing the right thing, but in retrospect, it turned out that they overpaid for those properties because they bought at the top, right? And the intrinsic value wasn't there. I think we're seeing the same thing in multifamily, which is to say that if you bought 3-4 years ago, right, you have like good fixed rate debt in place, you were going to be fine, right? You're probably going to return to what your original underwriting was like, right, for your 5-year hold, right? So but you're going to be disappointed because you're not going to get, like, when your expectations reset to this extraordinary level over the last 2 years because the market went nuts. Yeah. Like, you're going to be disappointed on that expectation, but you're not going to be like in trouble. You're not going to lose money, right?
I agree.
You're just not going to make as much money. Like, your eyes got real big the last couple of years, and like, you're going to have to dial it back to reality, but that's fine, right? Those people will be fine. The people who are going to have an issue are the people who are, like, as you just mentioned, bought at the top in the last couple of years, used, very aggressive debt in order to get those deals across the finish line, right? Those people are going to have a hard time. And the reason for that is, not, if you look at the debt structures they were using, there was a lot of bridge debt that was variable rate, right? Now, if you bought variable rate bridge, so a lot of those the bridge lenders are willing to lend to you much more aggressively. Obviously, the interest rates are higher, but they're willing to lend to you more aggressively, like give you more interest only, give you more proceeds, because it's not meant to be long-term debt. It's meant to be short-term debt. You're supposed to carry out your value add and refinance in a year or two and get out. So you're willing to pay higher interest for that because it's short-term, right? But people were starting to use bridge debt a little more like permanent debt. They were stretching out the terms, like 3 years plus 2 or 3 years of extensions, blah, 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 right? Because they couldn't get bank debt because the banks were like, these things don't underwrite according to our underwriting standards. So people were using more aggressive and frankly risky debt products in order to get deals done, right? And so what's going to happen, though, is just like in the great financial crisis, where a lot of people did bad deals on the expectation that the market was going to keep on rising and they would just sell out of it. Exactly the same thing happened in multifamily this time around, where the craziness of the last 2 years led everybody to believe that they would just be able to flip out for, in 2 years after they did their value add, because it was all going to be great. Yeah. What's happened now, though, is that, because interest rates are now rising, the first problem for some people is if they had variable rate debt and they didn't buy a rate cap, right, then they're already in a world of pain right now because their mortgages are now more expensive, right?
Significantly more.
Yeah. Significantly more expensive. And they may be having trouble literally paying their mortgage. So some people who were the most aggressive, who, went for these variable rate debt products, didn't buy rate caps because they thought they weren't necessary or they just didn't want to spend the money, those people are in big trouble, right? Mm-hmm. Now, or they bought the rate caps too high, right? Because they wanted to save money. They didn't buy them low enough, right? Those people are potentially in trouble, right? Because now what they have to do is that value add that they do, they've got to get a lot more rent to increase their NOI just to make debt service now. And they're probably in the middle of that process, so it's not completed, right? And then we talked about a moment ago that rents are softening. Well, so now their expectations of super high rent bumps, may not be realizable, right? So that's the first group of people who's in trouble. The second group of people who's in trouble are, maybe they're not in trouble right now. Maybe they're making their debt service now because they bought, fixed rate, either got fixed rate debt or they bought a rate cap to cap their increases. But what they're going to find when they need to, if they have to refinance next year, right, or maybe 2024, they're going to find that they're exiting into a completely different interest rate environment with, cap rates being higher, valuations being lower, and the proceeds they're able to get, being much lower, or at least being lower than their exit, projection. So the lucky ones in that group will just make less money. They'll be able to refinance, but really they just won't produce a good return. The unlucky ones are the ones who are not going to be able to refinance, right? And they're going to be forced to sell. So I think what a lot of us are now looking at in the business is that finally the opportunity that we've been waiting for may be around the corner, where there's going to be some people who have to sell and they have to get realistic about prices, and that maybe that will cause, you know, prices overall to soften a bit and make the buying opportunities a bit better. Now, obviously, I mean, a lot of people that are in the business, you know, like they're owners and buyers, right? So they don't, you know, they don't want property prices to go down too much because they own stuff. But on the other hand, if they've structured their deals correctly, right, they'll be fine. They can just always extend their hold period. You know, time is your friend in real estate. They'll make money in the long run. You know, but like I said, and you know, we have these conversations all the time. Nobody's wishing ill on their colleagues. Like nobody wants anyone to fail. However, it's not, you know, if some guy out there did a bad deal and like the interest rate environment changed, it's not my fault, right? Like I didn't cause his problem, but it is my opportunity. So, I mean, I think that's what we're looking for.
This is the environment that I thought we would be in early 2020, since I, you know, again, I took action and sold, and the pandemic kind of got away.
But nobody predicted I mean, I was in the exact same position. I sold at the same time for the same reasons, and I think it was the right choice at the right time.
I agree. Yeah.
Nobody, you know, like kicking yourself because you didn't predict the unpredictable is not really worthwhile, right? So
I agree.
So it's, but I do think that, and frankly, it might be a little bit worse now than it would have been.
That's where I was going. Is I thought it would be uncomfortable in 2020. I think this is going to be bad. I mean, I have seen, I mean, just my Facebook feed and all these other social media feeds, just the amount of deals done in the last 12 months that I just did cursory reviews of. I'm like, how can that pencil? And they got done and they got all this LP money. I'm like, there's going to be a lot of people that lost. So,
well, listen, I mean, there was I'm sorry to interrupt you, but there was such a frenzy amongst LPs for deals in the last 24 months. I had friends telling me that they fully sold out deals in 15 minutes, right? And you only have that kind of environment when there is a little bit of a feeding frenzy and kind of a bubble going on, right? And the fear of missing out is there. I don't think that you're going to see that again for quite some time. It's going to
it'll be a decade. This is going to hurt.
It's going to be harder for people to raise capital. But on the other hand, like, you know, I think a lot of people, it's sort of like a weird situation where, if you manage to get a deal and then you sell it for more than you expected because the market went crazy, and you're hoping, well, maybe you can do that once or twice more before the market changes. I mean, it's great if you time everything absolutely right. But I think a lot of people are kind of, if they're smart, they're sort of white knuckling it the whole time, right? They're hoping that they're going to get out, and they're planning to get out, right? But I think there is a certain segment of the market that just will take whatever the current situation is and just extrapolate it into the future forever and decide like, everything's, you know, this is the new reality. This is the new paradigm, right? You and I are both old enough to remember those phrases, right? So, and I've been kind of waiting for this to happen for quite some time, but it didn't play out. Obviously, it didn't play out the way I expected, right? I mean, I didn't think the pandemic was coming. Nobody did, right? When it happened, didn't think it was going to lead to. I thought the pandemic was going to lead to the crash, not to a bubble.
So I think what we have in front of us is, again, I think if we were going to head into 2020, again, I sold in 19, I thought we'd have a year and a half of negative kind, you know, some people would be, it would be basically an uncomfortable environment, but probably nobody gets crushed. Now people are going to get crushed. And I think it's going to take years to kind of unravel, you know, it's all about the debt structure blowing up over time. Can't refi, can't get out, forced seller. A lot of these GPs don't really have any meaningful skin in the game. These new operators, it's there's a lot of pain coming. So we have two more topics. We're going to tie into this one. Go ahead.
Before we jump off this topic though, one thing I want to say, one thing that's different about this environment than the last environment is the presence of the non-bank lenders, right?
Correct.
All these bridge lenders. Now, when so last time around, I mean, you and I, a couple of years ago, you and I used to talk about pretend and extend a lot, right? We haven't talked about pretend and extend for a while, but we used to talk about that a lot. And in the last, the lesson the banks learned from the last financial crisis was you can't dump a lot of foreclosed properties on the market all at once, because all you do is drive the value of your asset.
It's all bad. It's all bad.
Right?
Yeah.
So what they do is they dribble them out a little, they extend people, they try to manage the inventory in such a way that it never really hits the market, or it hits, they're picking their buyers, right? They're being very selective about it, right? Now that's banks, and banks, have like an implicit government guarantee behind them, right? So the banks also know that like the government's not going to let them go out of business, right? But these the hedge funds, the private equity funds, the debt funds,
the whole non-QM space,
right, that are all involved in this alternative lending space of bridge loans, right? Now, I think that those folks are going to find themselves in a world of hurt, and they may be fire selling assets because, and frankly, the alternative is that they go bankrupt, and then all these assets are tied up in bankruptcy for years, right?
Agreed.
So, and they can't be sold yet, even though everybody wants out. The owners want out, the LPs want out, the lenders want out, everybody wants out, but they're going to be caught in this like legal morass for 2 or 3 years. So that's kind of what is different about this time, and we'll see how that plays out. So, just food for thought.
No, it's going to be very interesting. And again, I think we delayed kind of what we should have been paying in 2020. That just means this next thing is going to be more. It's going to become operationally harder. The interest rate environment's different. It's going to be harder. Can you imagine being a GP reaching out to somebody for a capital call in the environment we're in now? That's not going to be fun. So, lots of great stuff, Jonathan. Where can people find you?
Yeah, so there's a couple places you can find me, but one thing, I was thinking about this before we got on the call. There's a lot of pain out there, and that actually makes me excited. And it's not because I'm a sadist, it's because, if you're an investor, it's times of distress that create the most opportunity. I really do think that finally the environment that I've been waiting for a long time is around the corner, probably the next 12 to 18 months. And so if you are thinking about getting into the multifamily business, now is the time to start learning, start building your network, start building your investor base. Because if you wait for the time when everybody's saying now's the time to buy, it's going to be way too late. So the time to get started on this is right now. So if you're interested in this, I have this great free checklist that takes you through the entire process of how you do multifamily deals. And if you want to syndicate them, how you do that too. And it's free. All you have to do is go to my website and you can download it. Just go to apartmentinvestorsclub.com and you'll find the download there. So unfortunately, I don't have it in front of me today. I know, Michael, you have the link. You can put it in the show notes, but
I will.
I really encourage you to go grab that download and start, if this is something that you're thinking about doing, like I said, now is the time to start getting your ducks in a row.
Awesome. And again, I totally agree with you. That will actually be episode number 2. I think the environment you and I were preparing for and got bamboozled is right in front of us. So I like you. I'm excited. Opportunity lives behind fear. Fear is right here for a lot of people. So I'm ecstatic. So Jonathan, thank you so much.
Absolutely.